One introduction success. Investment appraisal is at the core of capital budgeting, involving a rigorous evaluation of potential investment projects to determine their feasibility, profitability, and alignment with a firm's strategic objectives. In this module, we will explore traditional and discounted cash flow, DCF appraisal techniques, examine their strengths, weaknesses, assumptions, and real-world applicability, and apply them in multi-period, uncertain, and complex investment scenarios. Investment appraisal is not merely a mathematical exercise. It represents a crucial strategic decision-making process that shapes the future of a business. A sound appraisal ensures that limited capital resources are allocated to ventures with the highest value-creating potential. Traditional appraisal techniques, arts. Traditional methods are often used due to their simplicity and ease of communication, though they often ignore the time value of money. One payback period, PBP. The payback period is the time it takes for an investment to recoup its initial outlay from net cash inflows. Formula for uniform cash flows, PBP, initial investment, annual cash inflows text, PBP. For ACA text, initial investment, A text, annual cash inflow. For uneven cash flows, accumulate yearly inflows until the initial investment is recovered. Advantages, simple and intuitive, emphasizes liquidity. Useful in high-risk short-term projects. Disadvantages, ignores cash flows beyond payback, ignores time value of money. Not aligned with shareholder wealth, maximization. 2. Accounting rate of return, ARR. ARR uses accounting profit rather than cash flow to assess a project's return as a percentage of investment. Formula: ARR, average annual accounting. Profit initial or average investment, 100 text. ARR. NAFRAC text, average annual accounting profit. Na text, initial or average investment. Times 100 pros, easy to understand, incorporates profitability. Cons, based on accounting profit, not cash flow. Ignores time value of money. Can be misleading when comparing projects of different sizes. Discounted cash flow, DCF, techniques are: DCF methods explicitly account for the time value of money, making them superior in evaluating long-term projects. 1. Net present value, NPV. NPV is the sum of the present values of all cash flows associated with a project using a discount rate, often WSE. Formula: NPV, CT, 1/3, T, C0 NPV, Hasam, Yon Frac, CT, 1 plus RT, C0, where CTCT, cash flow in period, TRR, share discount rate, 0C, 0, share's initial investment decision rule. If NPV 0, accept. If NPV 0, reject strengths, accounts for time value of money, measures absolute value added, aligns with shareholder wealth maximization limitations, requires accurate cash flow projections and discount rate, can be difficult to explain to non-financial managers. 2. Internal rate of return, IRR. IRR is the discount rate that makes the NPV 0. Formula implicit, 0CT, 1 IRR, T, CV, 0, better asam on a frac, CM T at 1 plus IRR. A, T, Sila 0 decision rule, IRR, cost of capital, accept. IRR, cost of capital, reject advantages, provides a percentage return useful in comparing projects. Disadvantages, can be misleading with non-conventional cash flows, multiple IRRs, assumes reinvestment at IRR, unrealistic. 3. Modified internal rate of return, MIR. MIRR improves on IRR by assuming reinvestment at the cost of capital. Formula: MIRR, FV positive, CFS PV negative, CFS, 1 N 1 mirror. To left, Hifarak FV, positive XC, CFS PV, negative CFS, na right, 1 N. 1 key benefit. More realistic than IRR, eliminates multiple IRR problems. 4. Profitability index, PI, also called benefit cost ratio. PI is the ratio of the present value of future cash inflows to the initial investment. Formula: PI PV of future cash inflows, initial investment PI, was an FRAC PVVs of future cash inflows. Initial investment, decision rule, PI. 1. Accept PI. 1. Reject useful for capital rationing, where funds are limited and need to be allocated efficiently. Choosing between NPV and IRR. Criteria: NPV, IRR. Time value considered, consider decision rule, absolute value. Relative, percent reinvestment assumption, cost of capital, IRR, ranking conflict. Possible yes, multiple IRRs, no, yes for non-conventional CFs. NPV is preferred when projects are mutually exclusive, cash flows are non-conventional. Capital rationing is not an issue. Practical considerations in applying DCF techniques. Accuracy of cash flow. Forecasts. Uncertain forecasts can distort outcomes. Use scenario and sensitivity analysis. Choice of discount rate use. Project-specific WACC, especially for international or high-risk ventures. Project lifespan and terminal value. Ensure reasonable assumptions about salvage value and working capital recovery. Capital rationing. When funding is limited, use profitability index to rank competing projects. Intangibles, consider strategic benefits and non-financial gains, market share, innovation, etc. Case example, comparing investment projects, project, initial investment, yearly cash flow life, years, NPV, about 10% IRR, a $200,000, $60,000, 5, 24,189, 13.5%. Be $200,000, $70,000, 4, 30,145, 15.2%. Conclusion: both projects are viable, but Project B is preferred due to higher NPV and IRR. Adjusting WACC for risk, inflation, and capital structure. Leverage affects both cost of equity and WACC. Increased debt raises financial risk and equity costs. Inflation must be reflected in the discount rate if using nominal cash flows. Country risk premium, CRP, is added to WACC for projects in volatile environments. For multinational firms, WACC must be tailored to reflect different economic and financial conditions per region or sector.